All right, gentlemen, thank you for joining Danny and I here today.
Glad to be here.
We're happy that we're able to do this. Danny and I have put together videos in the past for our storage owners and operators, and we'd like to put one together today to discuss the capital markets. So I'll ask you to paint with some broad strokes here for a moment, and then maybe we'll get down into some of the fine print relative to the self-storage asset class. But right now, and let's back up and we'll kind of talk pre-COVID and during COVID. If we're having a range from a rate perspective, where were we? Where are we today? Is it influenced exclusively by where treasuries are? Is it sponsor specific? Is it geographically based? What can we talk about when it comes to rates?
With a broad stroke, rates have relatively been unchanged from pre-COVID to current environment, and everyone sees that treasuries have retracted quite a bit. Prime has retracted. LIBOR is at a near zero, but spreads have widened out given the inherent risk that we are in an uncertain environment. So when you look at all-in coupon, whether it's on a floating rate or a fixed rate, typically rates are unchanged. That being said, there are certain product types out there that we finance, and that's with the banks and that's the permanent loans. Now there is an area of financing that we get a lot done, which is with the bridge lenders and the mortgage REITs and the debt funds. Those type of lenders typically require a capital markets execution that's done through warehouse lines or CLO executions. Those lenders' pricing, they're either out of the market or their pricing is extremely wide because their capital markets executions aren't there. So when we had pricing, let's say in the L300 or 350 range from a debt fund, that's going to look like more like L plus 500 today, just because they're unable to finance their position in the capital markets.
Okay. What percentage of y'all's business is represented by portfolio lending versus the conduit markets versus life versus smaller credit unions and local banks? How are y'all diversified in that?
Great question. Historically, over our 28-year history, 60% of our business is done with the banks. So what that tells you is we do a lot of financing with local, regional, and even national banks for construction, fortuitous acquisitions, even term loans when borrowers want a little bit more flexibility on prepayment. So we do quite a bit of bank financing. That other 40% equates to CMBS life company type permanent debt. We also do a lot of preferred equity and mezzanine financing, and then some JV capital. In addition to that, also the non-recourse bridge financing we do quite a bit of, but currently in today's environment that we're not seeing a whole lot of bridge lending getting done.
Is there a difference from a rate and LTV perspective between the CMBS markets right now and call it everything else?
I mean, I'd say CMBS at this point in time, given they're kind of turning the spigot back on, the highest real LTV we've seen thus far is about 65%. And relative to everything else, I'd say, banks, credit unions, they could still stretch up to 70 or 75, assuming recourse and assuming a strong borrower. So that's really I'd say the difference that drives the leverage.
So CMBS is still non-recourse, provided we still have the conventional bad boy clauses and so forth.
Absolutely.
Okay.
And that we don't see that change.
So the general theme that we're seeing, and today, again, sitting in the middle of summer 2020, as the CMBS market has reopened, general leverage is down about 10%. So deals that you were getting done at 75% pre-COVID or 65%. At 65% pre-COVID are now 55%. So that's what you're seeing. That being said, as we get through this COVID environment and there's more product to be financed, we think that the leverage points will come up again.
So reopened presumes that there was a previous closing. How long was that the case, and was it just for CMBS exclusively, or what was y'all's experience?
Mainly CMBS, but as Sonny mentioned, the CLO executions and the warehouse lines also were kind of shut down. CLO is kind of a cousin to CMBS.
Right.
And so we saw the CMBS completely come to a halt in mid-March, and they re-entered the market about the last week of May. And when they did, like anything else, they dipped back into the market with caution, and as such, they dropped leverage and they tried to maintain their spreads equal to a rate of kind of where they were before, although the 10-year is so low that you can borrow on a CMBS at sub 4 for the right deal. 10-year
Really?
fixed.
Sub
Yeah,
four.
we have a deal in the shop right now that if it were to lock today, it'd be about 3.6, 3.7. Is that right, Sonny? So that's
10 years IO.
10 years interest only.
Wow.
60%.
Interesting.
So there's aggressive money out there if you have a deal that fits in that lower leverage
Right.
box.
Right.
So also to your question, how long was the capital markets closed? It never closed. There was a lot of liquidity in the market. It just depended on where you were to get it from and at what leverage and price.
Right.
And when the CMBS market, we like to look at the CMBS market kind of the top of the food chain, because when the CMBS market shuts off, that's the ultimate backstop and exit to other types of lenders. So banks, bridge lenders, more transitionary assets, we usually underwrite to a CMBS exit, because that's the kind of the fail-safe and the liquidity for all product types. When the CMBS market turns off, all other capital sources proceed with caution because they're not sure whether there's an exit. Now that CMBS market has come back into play for product types that are outside of hospitality and some retail, those other lenders, banks, bridge funds, life companies, et cetera, are coming back into the market.
Yeah, let me say it a different way, just so we can hit both angles here. The banks and the credit unions never got to see pristine, fully leased up, stabilized cash flowing deals that they got to make loans on. It was very rare. Their bread and butter was making loans on construction or transitionary product types, or something where, as Sonny mentioned, the borrower just wanted flexibility. So when that happens, banks don't have to go down the risk spectrum to make loans. So they say to themselves, why would we take construction risk when we can make loans on these stabilized assets? Because CMBS is no longer, so they're going to go take their share of those assets at the moment. What Sonny is saying is that now that CMBS is opening back up, those loans will start to move off those banks' books, and the banks will then start to have to divert their attention to what they used to do, which was construction, assets that aren't quite nearly stabilized, where you need some recourse. And so you'll see the market start to open back up at a lagging effect from CMBS opening back up. So while some borrowers will tell you, we don't want to borrow CMBS, we don't like that product type, it's definitely a good thing to see them come back. As Sonny mentioned, it is the top of the food chain, and when those lenders come back in the market and provide liquidity, it takes loans off the banks.
Sure.
And their banks. So then it starts the engine to go again.
That's good. That's good impact. And interesting concept there.